Look, I need to talk to you about silver in 2026 because we are entering a phase that I think most investors are completely misunderstanding. They are either dismissing it entirely or they are approaching it in ways that are going to cost them money. And what I want to do is give you a framework for thinking about this asset. Class that is based on fundamental supply-demand dynamics, macro trends, and intelligent capital allocation, not on emotion or apocalyptic narratives. I'm Raoul Pal, and I've spent decades analyzing global macro trends and trying to identify asymmetric risk-reward opportunities before they become obvious to the broader market. And what I am seeing in silver right now is one of the most compelling setups I've encountered, but only if you approach it correctly, if you approach it the way most retail investors do. You're going to lose money or at best miss the opportunity. Before we get into the specific strategy, hit that subscribe button because the analysis I'm about to share connects industrial demand trends, monetary dynamics, supply constraints, and investment structuring in ways that mainstream commentary completely misses. This is institutional level thinking about a commodity that most people treat emotionally. Let me start with the macro framework because nothing happens in isolation. We are living in a world where two massive forces are converging: the energy transition and the digital transformation. Both require enormous amounts of physical infrastructure, and at the center of that infrastructure is silver, the most conductive element on the periodic table, essential for solar panels, electric vehicles, 5 grams networks, AI data centers, and increasingly next-generation battery technology. At the same time, we're in a monetary environment where central banks are trapped between inflation concerns and growth concerns, where currency debasement is structural, and where real assets with genuine utility are becoming increasingly valuable. Silver sits at the intersection of these trends. It's both an industrial commodity and a monetary metal. That dual nature creates interesting dynamics. Now here's what you need to understand about silver's supply-demand fundamentals, because this is critical. We're in the 5th consecutive year of a global supply deficit. Consumption exceeds mine production by over 150 million ounces annually. We've been drawing down above-ground inventories to fill the gap, but those inventories are depleting. COMEX registered silver, the stuff actually available for delivery, is at multi-decade lows. Shanghai inventories are falling. The physical market is getting tight. Why is supply constrained? Because silver is predominantly mined as a byproduct of other operations: zinc, copper, lead, gold. When primary miners are focused on base metals or precious metals, silver supply is essentially a residual. It doesn't respond quickly to price signals. Even if silver prices double, it takes 7 to 10 years to bring new primary silver mines online, so supply is sticky. Meanwhile, demand is accelerating. Solar installations globally are growing at double-digit rates. Every panel requires 20–30 grams of silver paste for conductivity. There's no economically viable substitute at scale. EVs use 2 to 3 times more silver than traditional vehicles. 5 grams infrastructure rollout requires silver. And here's where it gets really interesting: solid-state battery technology. The automotive industry is racing towards solid-state batteries because they solve the range and charging time problems that are limiting EV adoption. And the leading chemistry, the technology being developed by Samsung, Toyota, and others, uses silver carbon composite anodes. A traditional EV might use 30 grams of silver in electronics. A solid-state battery EV could use up to 1 kilogram. That's a 30x increase in silver intensity per vehicle. Let me run the numbers for you because this matters. If just 20% of global EV production shifts to silver-intensive solid-state batteries by 2027 to 2028, that alone would consume an additional 150,000 metric tons of silver annually. Global mine production is roughly 25,000 metric tons. One technology shift in one industry could consume 60–80 of annual mine supply. Layer that on top of existing solar, electronics, and traditional industrial demand, and you have a structural deficit that's not just large, it's potentially catastrophic from a supply standpoint. This is what I call an industrial squeeze. And when you get these supply-demand imbalances in commodities, especially commodities that are essential for technological infrastructure, prices can move dramatically. We saw it with lithium when EV demand surged. We saw it with uranium when nuclear became acceptable again. Silver is setting up for a similar dynamic, but most investors don't see it yet because they are looking at silver as poor man's gold rather than as critical industrial infrastructure. Now here's where most people go wrong. And this is important. They hear this thesis, they get excited, and they rush out to buy physical silver coins or bars from a dealer. And they get absolutely destroyed on the spread. They pay 20–30 premiums over spot price, sometimes 40% for certain coins. They're buying from dealers who are marking up product massively because they know demand is increasing. If you pay $35 for an ounce of silver when spot is $27, you need a 30% rally just to break even. That's a terrible starting position. You've given away a huge portion of your potential return before you even begin. This is not intelligent capital allocation, this is emotional buying, and emotion is the enemy of profitable investing. Let me also address the opportunity cost issue because this matters in 2026. We are in an environment where cash yields for -5 in money market funds. If you buy a physical asset that yields nothing and store it in a vault, you're losing that for -5 annual yield. That's your hurdle rate. Silver doesn't just need to go up, it needs to go up more than the risk-free rate plus storage costs plus the premium you paid to acquire it. That might be 30 minus 40 total before you actually make money. So how do you capture the silver opportunity without these structural disadvantages? Let me give you a framework that's based on how sophisticated investors think about commodity exposure. First, you need to size this position appropriately. Silver is volatile. It's moved 50% in a quarter before, both up and down. If you're allocating too much of your portfolio to this, you're going to get shaken out at exactly the wrong time. I'd suggest 3-7 of a diversified portfolio in precious metals exposure, with perhaps half of that in silver if you have high conviction in the industrial demand thesis. Second, you need to think about how to get exposure without paying massive premiums or giving up yield. There are several ways to do this, and they're not equal. The simplest and most cost-effective for pure price exposure is a physically backed ETF that trades at or very close to net asset value. You're getting spot price exposure with maybe a 0.5% annual management fee and tight bid-ask spreads. You can buy and sell instantly during market hours. No storage concerns, no insurance, no authenticity risk. You're just capturing the price move if your thesis is correct. The disadvantage is you don't have direct ownership of physical metal. In a true systemic crisis where you need actual metal in your possession, you can't take delivery from most ETFs. But if your thesis is industrial demand driving prices higher over 2 to 5 years, which is my thesis, then ETF exposure is perfectly adequate and far more cost-effective than buying coins at 30% premiums. Now, if you want to add a cash flow component, and I always prefer investments that generate cash flow, you look at silver streaming and royalty companies. This is the most elegant way to play commodity cycles because you get leveraged exposure to the underlying commodity price without the operational risks of actually mining. Here's how the model works. A streaming company provides upfront capital to a mining company. In exchange, they get the right to purchase silver from that mine at a fixed, low price, maybe for $5 per ounce for the life of the mine. So when silver is trading at $30, they buy it for $5 and sell it for $30. When silver goes to $60, they're still buying for $5. Their margins expand exponentially as prices rise, and here's the beautiful part: they don't run the mine. They don't have labor issues, equipment breakdowns, permitting problems, environmental liabilities. They just collect the silver at their predetermined price. It's pure leverage to the commodity with minimal operational risk, and many of these companies pay dividends, which means you're getting cash flow while you wait for the silver price to move. The third bucket, and this is higher risk, higher potential return, is well-positioned silver miners or developers in safe jurisdictions. The key is to be very selective. Most mining companies are terrible businesses. They're capital-intensive, operationally complex, and often mismanaged, but the best miners in the best jurisdictions with the lowest all-in sustaining costs can deliver extraordinary returns when commodity prices rise because of operating leverage. If silver goes from $30 to $60 and a company's cost is $20, their profit per ounce doubles, but their margin goes from $10 to $40. That's 4x. That operating leverage translates into equity performance, but you have to be disciplined about which companies you own, and you have to be willing to take profits when valuations get extended. So if I were structuring a silver position in 2026, it might look like this: 50% in physically backed ETF for pure price exposure, 35% in top-tier streaming companies for leveraged exposure with cash flow, and 15% in high-quality miners in Canada or Australia for maximum upside. That's a balanced approach that captures the opportunity without concentrated risk in any one vehicle. Now let me talk about timing and volatility because this matters for execution. Silver is not going to move in a straight line. We're going to see massive swings, 20-30% moves in both directions. The market is going to panic about recession, then panic about inflation, then panic about supply, then panic about demand. This volatility is going to shake out weak hands constantly. Your job is not to trade this volatility. Your job is to position for the multi-year structural thesis and hold through the noise. If your thesis is that solid-state batteries are going to consume massive amounts of silver by 2028. Then a 15% pullback in early 2026 because of some Fed commentary is noise. It's an opportunity to add, not a reason to panic. This is where dollar-cost averaging is valuable. Rather than deploying all your capital at once, spread it over 6–9 months. You're smoothing out your entry price and removing the pressure of trying to time the bottom perfectly. Some months you'll buy higher, some lower. Over time, you get a reasonable average cost basis and you're building the position systematically. Let me address the gold to silver ratio because people always ask about this. Historically, silver trades somewhere between 40:1 and 70:1 relative to gold. Right now we're at roughly 85:91, which suggests silver is cheap relative to gold on a historical basis when that ratio compresses, and it often does. During inflationary periods or commodity bull markets, silver outperforms gold significantly on a percentage basis. But ratios can stay distorted for years. I don't trade ratios, I trade fundamentals. If the industrial demand thesis is correct, if solid-state batteries are deployed at scale, if solar continues to grow exponentially, silver is going higher regardless of what gold does. The ratio might compress as a side effect, but I'm not betting on mean reversion. I'm betting on supply-demand fundamentals. Now let me talk about the risks, because every thesis has risks and you need to understand what could go wrong. The biggest risk is demand destruction from recession. If the global economy enters a severe downturn, industrial demand for silver falls, solar installations slow down, EV production declines, electronics demand weakens. In that scenario, silver prices could fall sharply despite the structural deficit. My counter to that risk is that we are in a world where fiscal stimulus in response to any recession is going to be massive. Governments are not going to let recessions run their course. They're going to print, spend, and stimulate. That's inflationary medium term, which supports hard assets. So even if we get a recession-driven sell-off, in silver, I'd view it as a buying opportunity rather than a thesis break. The second risk is technological substitution. What if someone develops a solar panel technology that doesn't require silver? What if solid-state batteries end up using a different chemistry? These are low probability but non-zero risks. You have to monitor the technology landscape and be willing to adjust if the fundamentals change. The third risk is government intervention. If silver prices spike too much and it's threatening the energy transition or EV adoption, governments could intervene. Export restrictions, price controls, strategic stockpile releases. We've seen this playbook with other commodities. It's a tail risk, but it's real. The way you manage these risks is through position sizing and diversification. Don't bet the farm on silver. Keep it as a meaningful but not dominant position in a diversified portfolio. And within your silver exposure, diversify across ETFs, streamers, and miners so you're not concentrated in one vehicle. Let me talk about the macro overlay because this affects how silver performs in different scenarios. In an inflationary environment where purchasing power is being eroded, silver as a monetary metal performs well. In a growth environment where industrial production is accelerating, silver as an industrial commodity performs well. That's the beautiful thing about silver's dual nature. It can work in multiple macro regimes. The worst environment for silver is severe deflation with collapsing demand. That's the one scenario where both the monetary and industrial aspects work against you, but given central bank behavior globally, given the political economy of deficit spending, I think sustained deflation is the least likely scenario. We're much more likely to see inflation or stagflation, both of which are supportive for silver. Now let me address the physical vs paper debate because I know some of you are wondering about owning actual metal. My view is this: if you want to own some physical silver as part of a broader strategy, fine, but be smart about it. Buy from reputable dealers, buy recognizable products, government-minted coins or bars from major refiners. And understand you're paying a premium for the privilege of physical possession. Store it securely either in a safe at home or in allocated, segregated storage at a private vault, not a bank. And recognize that this portion of your silver allocation is insurance, not investment. It's the piece you might never sell, the piece that's there for worst-case scenarios. But it shouldn't be your entire exposure because the costs are too high. The bulk of your allocation should be in cost-effective vehicles like ETFs and streaming companies where you are capturing the price move without friction and ideally generating some cash flow. That's intelligent capital allocation. Let me paint the scenario I think is most likely for 2026 to 2028. We're going to see silver prices consolidate early in the year as macro uncertainty dominates. Then, as the year progresses, we're going to start seeing industrial users announce long-term supply agreements, strategic stockpiling, concerns about availability. We're going to see inventory drawdowns accelerate. We're going to see the first solid-state battery production announcements from major automakers. All of this is going to create a narrative shift from silver is volatile and risky to silver is strategic and scarce. When that narrative shift happens, when CNBC is doing segments on the silver shortage, when Bloomberg is writing about supply chains, that's when prices really move. But by then, the easy money has already been made. That's why I'm positioning now, before it's obvious, before everyone sees it. The opportunity in markets is always in the gap between what's true and what's priced in. Right now, the industrial demand trajectory for silver is not fully priced in. The solid-state battery impact is not priced in. The ongoing deficit is not priced in. When the market catches up to reality, we'll see a repricing, and I want to be positioned before that happens. My base case is that silver reaches 60.75 by late 2027 or 2028 as the supply-demand fundamentals become undeniable and as solid-state battery production begins to ramp. That's roughly 2x from current levels. The streaming companies could do 3-5x in that scenario because of operating leverage. The best miners could do even better. That's the asymmetry I'm looking for. But I also have to acknowledge I could be wrong. The technology might not roll out as fast as expected. Recession could hit harder than anticipated. Substitution could happen faster than I think. That's why position sizing matters. That's why diversification matters. I'm betting on a high probability scenario with attractive risk reward. But I'm not betting everything on it. If you found this framework valuable, if you see the opportunity in silver, but want to approach it intelligently rather than emotionally, leave a comment and let me know what percentage of your portfolio you're allocating. Are you going heavy on physical? Are you focused on streaming companies? I want to hear how people are thinking about this. Share this with anyone who's considering silver exposure but doesn't know how to structure it, and subscribe because we're going to keep tracking this story throughout 2026 and beyond. The commodity cycle is just beginning, and silver is one of the most compelling opportunities within it, but only if you play it smart. The setup is there, the fundamentals are there, the opportunity is there. Now it's about execution, sizing it right, structuring it intelligently, and holding through volatility. That ease how you profit from silver in 2026 without getting caught in the traps that destroy most retail commodity investors. Position yourself accordingly.